Valencia Roca, and today we will work on the financial forecasts every entrepreneur should have. And we have here an Excel spreadsheet where you can see different steps. The first will be the sales forecast, how much we expect to obtain in revenue. Then the income statement with all the expenses. Then the balance sheet, a forecasted balance sheet for the next 5-6 years, and then a perpetuity. Then we need to compute free cash flow if we want to evaluate this investment. The objective being to determine whether this is a good investment project or not. There is another methodology that we are going to use, which is the economic value added, the EVA. They will lead to the same result, but they will explain how the project is creating value in a different way. And finally, the question we would like to answer is this a good investment project? So this is a template that you can download with the book, and you will read with more detail about this example in the book. But here I will work step by step, covering all the at least minimum financial forecasts that we need. So let's start with the sales forecast. A big question is always how much will the company grow? And if this is a new project, that will be a very difficult question to answer. In case we have some historical information from this business or a similar one, for example, a similar project in another country, then we can calculate the annual growth rate of such project and apply it here, at least for the short term. Then for the long term, it is more conservative to assume that there will be a fade rate, which means that the effect of competition will reduce the economic profit in the long term, at least. Maintaining an advantage, a competitive advantage in the long term is very difficult. Not many companies can do it. So in this case, we will work with two different growth rates. First, high growth rate, which we will calculate from a similar entrepreneur, and then a long-term growth, which will be like the economy growth, very, very small, like 1, 2, 3%, no more than that. So let's start. We have in line 7, you can see these are sales for the last 10 years of another business, of another company, a similar one with similar risk, but another company. So the first thing will be to calculate the logarithm of those sales. I will use the Excel function log, which is the same in Spanish or English if you are using an Excel spreadsheet. So it's going to be the log of sales. We do this for every year. For example, for 2013, the log of sales is 5.56. This is an exponent. It means that the base of the logarithm, which in this case is 10, to the power of 5.56 will result in the sales of 2013. Now, using a regression analysis, I will find the slope formula. Using a regression analysis, we'll see that the slope of the regression will give us an idea of the growth in this data. So, in formulas, we can find slope, and Excel will need to different groups of data. What we want on the I and what we want on the x-axis. So the I will be the log of sales, and the x will be the years. Okay, here we have the slope, and then 10, which is the base of the logarithm, to the power of the slope, minus 1. Okay, here we have the growth rate. According to this information, we are going to forecast a 13% growth rate each year, in the short term at least. And then in the long term, we're going to use 2%, which is in this case what we assume for the economy. Now, let's forecast sales. We could do this in units, using also a price per unit, or just in US dollars. So the growth rate will be 13%. And how much do we expect to sell next year in 2015? Well, assuming, for example, that the historical sales were 419, then we multiply by 1 plus the growth rate. We could perfectly start here in 0 or in any number. And then again, for the next year, the previous year times 1 plus the growth rate. Okay, now please recall that we are not using the 2% growth rate anywhere here in the cash flows. We will use that one on the denominator of the discount rate, of the discount factor, I'm sorry. So that will have the effect of calculating the present value of a perpetuity growing at 2%. Now we have sales, we have here forecasted sales. We can use this methodology or any other methodology to estimate how much we expect to sell. I know that every entrepreneur has an idea of this number. He could be right, he could be wrong, but this is a number that we all estimate. How much do we plan to sell? Then we need an estimation for the cost of sales. Let's assume 15% of sales. This would be a variable cost. So sales times 15% for each year. As sales are increasing, cost is also increasing, as you can see. Now, the gross margin or gross profit will be sales minus the cost. Okay, and now we have other operating expenses which could be fixed. For example, here G&A will be $120,000 each year. It's completely fixed. It does not move or change with the growth of sales. The same with depreciation. In this case, it will depend not on sales, but on the fixed assets that we need to support that growth of sales. And then we have publicity, which will be a direct cost in this case, or expense, 8% of sales. I'm sorry, 8%. And then other operating expenses, which would be 10%. Okay, now here we calculated operating profit, deducting from gross profit all the expenses. This is very easy to do. This is normally what we know about the business. How much will we grow, and how much sales will be, what are the estimated costs. Now, from now on, the calculations will be a little bit more financial. Many entrepreneurs forget to forecast the balance sheet. Recall that here we need to stop because we cannot forecast the interest expense, which will have here a 7% cost, but we cannot forecast the expense on debt if we do not know how much debt we need. Therefore, we will stop here and then we'll come back to the income statement later. Let's move to the balance sheet. Now, in the balance sheet, what we need is just a list of all the assets that the business will need. For example, inventory, cash, machinery, equipment. And that is the most important part, the left side of the balance sheet. A kind of a list of what we need and how that will change in future periods, because one of the biggest problems of entrepreneurs is forgetting to forecast the balance sheet and therefore forgetting to forecast investments in the future. Many entrepreneurs assume that the project will just need an initial capital, a seed capital, and then it will finance itself. It would be financed with sales, for example. And that is not true for most projects. Therefore, here, what we need is very simple. This is not an accounting calculation. It's just a list of the assets that we need to support sales. And then for the right part, we will just assume in this case that 20% of those assets will be covered by some kind of loan or debt. And then 80% will be covered by stockholders. This is equity. All right, then now we need to separate fixed assets and variable assets regarding sales. We are defining fixed or variable according to sales. For example, usually the current assets as inventory or accounts receivable are variable. Is it possible to sell more without keeping more inventory? For many businesses, that is not possible. Is it possible to maintain a certain policy of financing to clients and sell more but maintain fixed the accounts receivable? Is that possible? For many businesses, again, this is not possible. Therefore, current assets are usually in one way or another related to sales. In this case, we will assume that, and for example, cash, and I mean here only operating cash, for example, cash that McDonald's has in its register machines, or Starbucks, that is operating cash. What we really need for the business. Well, in this case, it's going to be 2% of sales. As you can see, if sales go up, then the amount of cash will go up as well, because it's like any other asset. Like we need more inventory, we need to keep more money in the cash machine or in banks. Then accounts receivable will be 20% of sales, which means that someone will need to finance this growth. Maybe sales will be enough, maybe not. That's the reason why we need the balance sheet. Then we have 120% of sales on inventory and 10% of other current assets. Okay, now the total for each period here relates directly to sales. But that will not happen with the non-current assets. In this case, we assume, well, accounts receivable will be 2% of sales, but this is long-term accounts receivable, right? But then we have machinery and vehicles, land, buildings that will allow growth in sales without a further investment. Therefore, we will maintain machinery in $100,000 and $50,000 for vehicles, $300 for land, $150 in buildings, and then we have others of $20,000. And depreciation, which would, remember, it was $32,000 each year, and we will accumulate, as you can see, we'll start in 0, and then we will accumulate the depreciation that we have on the income statement. Remember that we already have this number on the income statement. We are depreciating a certain amount each year, and then we are accumulating this number on the balance sheet. It's the same number, but it's shown in a different way. Okay, and now total assets. Total assets will be current assets plus non-current assets, net of depreciation, of course. Okay, this is the total capital that the company will need. In this case, remember that we're not forecasting non-operating assets. You cannot see here investment in other societies or goodwill or excess cash. We're just forecasting what we need in the operation. Therefore, assets are equal to capital. And in this case, we are also assuming that accounts payable are not free, and that we need to pay interest on accounts payable. Therefore, we can assume very easily in this example that assets, total assets or net asset value, are equal to capital. Now, let's go to the right part of the balance sheet. We don't really need this for the cash flows. We will take into consideration the financial structure, the capital structure, in calculating the discount rate. When we calculate the WACC, then we will need this 20 and 80% financing mix. Okay, now for the first year, 20% of this amount will be debt, and 80% again of this amount will be equity. And of course, the sum should be exactly the same number we had above. Therefore, the balance sheet should balance. The difference, you can see, is 0. Okay, the balance sheet should balance. The right side is equal to the left side. Okay, now let's move to the free cash flow and EVA. These are the valuation methodologies that will tell us, at least for now, without any further analysis, whether this is a good project. And so the first one, the free cash flow, will be an estimation of how much cash the company will generate or demand. And this will be NOPAT minus net investment. Again, NOPAT minus net investment. Where do we obtain NOPAT, net operating profit after taxes? Well, if this is a profit, it's going to be on the income statement. And if it is the operating profit, please recall that we do not need to forecast interest, right, or net earnings. We don't need that. We may, if we like, we may complete this part. How much will interest expense be? Well, if the cost of debt is 7%, and we see on the balance sheet that we expect to have 270 in debt, then interest will be 18, almost 19 for the first year, and then it will increase as debt increases. Then how much tax will we pay? If here the income tax rate is 30%, the forecasted, the marginal income tax rate. Remember that these are forecasted cash flows. If the income tax rate is 30%, then we need to calculate operating profit minus the deductible interest expense times the tax rate. So this is the tax we expect to pay each year. And now what is net income? Again, we don't need this part. We only need the line 28 where we have the operating profit, okay? But if we want to finish and present a complete income statement, then net income will be operating profit minus interest minus taxes. All right. Okay, here we have net income. And okay, I will hide this for a moment. We don't need this. And I will calculate NOPAT, net operating profit, again, net operating profit minus tax or less taxes. Then this will be the operating profit, which is what we have on line 28, times 1 minus the tax rate. Remember, it was 30% in this case. So we are deducting taxes, but not real taxes. We are deducting the hypothetical tax that a company without any debt would pay. A full equity firm would pay 30% on the EBIT. And that is what we are doing here. Notice that NOPAT is not influenced in any way by debt or the amount of debt and equity, the financing mix the company has. This is nothing to do with it. It's like determining how much profit all the assets will generate. Machinery, inventory, all the assets, no matter where we obtain debt to finance them or equity. Doesn't matter. Okay, no, but this is what the company obtained or is expecting to obtain in its operations. Now, can we, as shareholders, take this cash and take it home? No, we can't. Can we pay a dividend on this cash? No, we can't. We need to invest for the future. We need to invest according to the growth that we have forecasted. So how much will the investment be? Okay, we have that number because we have the list of all the assets that are going to be needed in the future. We have capital. How much is capital? Well, we mentioned that we will assume, in this case, capital equal to total assets. Okay? As you can see, capital is growing, especially it's growing due to the current assets in this case. It's growing because we are expecting to grow on sales, and we can do it with maintaining fixed some assets, for example, land, but we cannot do it without more inventory, more accounts receivable. And then please note that I will forecast 1 extra year of capital. You'll see why. And to be consistent here, we need to use the same long-term growth rate we are assuming for this example, which is 2%. Remember, a similar rate to the economy. So I will forecast an extra year using 1 plus 2%. Here, we call it long-term growth rate. Okay. It could be 0, right? It could be 2%, 1, 2, 3%. It depends. Now, how much do we need to invest? For example, see that capital is growing from 1.3 million to 1.4. Therefore, the difference is investment, is net investment, because this capital is already net of depreciation, of accumulated depreciation. So this net investment is the investment to grow. If net investment is 0, it means we are exactly covering depreciation. That's what it means. In this case, it will be positive. We are buying assets. how much is net investment? The capital we will need next year minus the capital we have today. Okay, 66 in the first year. And in the second year, 79, because the capital will need to grow from 1.4 to 1.419 to 1.499. Therefore, if the capital is growing, net investment will grow, will be positive, will make it possible, will make it possible for the capital to grow. We'll copy for every year, and in the last year is here you can see why we needed to forecast an extra year, because we are comparing capital next year with what we have today. Assume if instead of forecasting 2% growth, we would have assumed 0 growth, a stable company, a stable growth model from year 2020 on, then this would be a 0 net investment, which means we are maintaining the capacity, we are fixing whatever is broken, but in other words, we are covering depreciation. But this would only be consistent with constant sales. Without increasing in some way efficiency, this is the reasonable way to forecast. Well, in this case, we are assuming a 2% growth in sales, and therefore, in order to make it possible without any increase in productivity, well, we'll need to invest a 2% more in capital. That's the assumption we are doing here. Okay, how much is free cash flow? NOPAT minus net investment. For example, for the first year, this is the number which we obtained from the income statement. This is a profit. The company is expecting to obtain 139 in profit in its operation, but it will invest 66, therefore, which comes from the balance sheet, right? Which means that the free cash flow will only be 72. If we don't invest, then the free cash flow will be NOPAT, will be 139. If we only cover depreciation, then all the earnings obtained in the operation will be free cash flow to the firm. But in this case, we are investing for the future, and therefore the free cash flow is 72. For the following year, the same happens. NOPAT is bigger than the net investment, therefore the free cash flow is positive. Well, the same happens for each year. Now, please recall that the sign of the free cash flow, positive or negative, does not mean anything. Does not mean that the company is doing well or is doing bad. It only means that NOPAT is bigger than net investment in the case free cash flow is positive, or that NOPAT is less than net investment in the case the free cash flow is negative. It depends on one decision. Free cash flow is a number that depends on the decision to invest. Therefore, we cannot pay bonus or any type of compensation based on free cash flow. It means that the company is obtaining cash or is losing cash, but in the way that it could be investing. The free cash flow could be negative in a very profitable firm, only if it's investing. What we do mind is the long term. In the long term, if we have negative cash flows right now, then we expect that such investment, for example, to generate positive free cash flow in the future. Therefore, if we take the whole forecast, the whole timeline, at some point, if we have negative cash flows, they need to turn into positive free cash flows. So Could we just simply add all the cash flows? No, we need to discount them to present value. Okay, we may separate how much goes to debt and how much goes to equity. We may separate that if we like. But let's discount the free cash flow to present value. And then I will do this and then I'll go back to EVA. Free cash flow to the firm, in this case, is what we have on line 66. And now we need a discount factor. The discount factor for the first 5 years will be 1 divided by 1 plus the weighted average cost of capital to the power of the respective year. For example, 1, 2, 3. Then the last discount factor will be different because we are working here with a perpetuity. So let's assume the weighted average cost of capital to be 12%. That's the opportunity cost. That's the discount rate to calculate, in this case, present values. Now the discount factor for the first year will be 1 divided by 1 plus the weighted average cost of capital to the power of 1. 89%. Each dollar received in 1 year today has only a 89% value. It's 89 cents. $100 that we expect to receive in 1 year today have for us only the value of $89. If the same $100 are expected to be received in 2 years, then the value today is smaller, of course. It's only $80. And for the last one, this will be the discount factor from a perpetuity, a deferred perpetuity, a perpetuity which will start on year 6. So the discount factor will be 1 divided by the weighted average cost of capital minus the growth rate. This is the long-term growth rate. In this case, it was 2%, right? 2% times the previous factor. 1 divided by 1 plus the weighted average cost of capital, in this case to the power of 5, the previous factor. If the perpetuity starts on year 6, then, well, the number we are using is 5. Okay, I'll do it here. 1 divided by the weighted average cost of capital minus the long-term growth rate times the previous factor. I already calculated the previous factor. It's 0.57, so I'll just use it. All right. We always have it on the left side. All of this is 0.57 in this example. Therefore, all I did was to divide 1 divided by the weighted average cost of capital, which is 12%, minus the 2% long-term growth rate times the previous factor. Okay. Now, let's go to calculate the present value of free cash flows. That will be the free cash flow times the discount factor. For example, for the first year, we expect to receive $72,000 on free cash flow, but that will only be in 1 year. So now the value for us is smaller than that. It's 89% of such value, is $65,000. We repeat this for every year. Recall that the last one is bigger because it means we are adding all the cash flows from year 6 on growing at 2%. The effect of using that 2% on the discount rate is to take into account the perpetuity. If you would like to review these discount formulas, you can see chapters 3, 4, and 5 of our book. Okay. Now the enterprise value will be the sum of all the present values of free cash flows. This is, in other words, how much is a project or a firm worth to me? Well, all the money that I will obtain with the company. It's as simple as that. The money that if I expect to be richer in terms that I am expecting a lot of money, then that project has a higher value than if I do not expect to receive a lot of money. That is as simple as it is, as it sounds. That is the discounted cash flow methodology, the most common way to evaluate projects. Now, we would like to also have a criteria. Is this good? Is this a good investment? Well, we'll need to compare the enterprise value with the capital we are investing today, the initial capital which we had before. We are investing today $1.3 million in machinery, buildings, inventory, etc. And we expect to obtain $1.8 million. Therefore, net present value is 535. It's positive. Is this a good project? Yes, according to this methodology, this is a good investment because the inflows of cash we expect are higher than the outflows, even considering the initial investment. Okay, the same result will be obtained with the second methodology to evaluate this project, which is the economic value added, EVA, step 5 in this case. But it's going to be interesting to calculate both because, as we mentioned before, free cash flow does not tell us whether we are going well, whether the company is profitable or not. It's just there's cash coming in, there's cash coming out. It could be for different reasons. We could even see cash coming in because we went to the bank and asked for a loan, and so the bank deposited the loan, and so some cash is coming in. Or we could see outflows of cash because we are investing, we are buying land, property, etc. Therefore, the free cash flow approach is very good, it's very common. The net present value approach is the most common criteria to evaluate investments, but the economic value added will give us better information about why this project has value and when do we see good years, are we forecasting good years or bad years. Even though these two criteria will lead to the same final value creation in one case, net present value in the other case, but the explanation is going to be different. Okay, the starting point of EVA is the same as in the free cash flow methodology. NOPAT and invested capital. We already calculated NOPAT. We have it here on line 64. Okay. Net operating profit after tax. How much the company was able to generate in its operations. For example, for the first year, we're forecasting to obtain $139,000. Okay, is that good? Is that a good profit? I don't know. It depends on how much money we need to invest to obtain those 139. But we know that number because we already have a forecast of the balance sheet. So we have a detail of all the assets that we will need. We will need, for example, in this case, some cash, We'll need inventory, other current assets, machinery, land. So capital here is 1.3 million for the first year. This is the same number we had before. Okay, it's basically operating assets. That is what capital means for the EVA methodology. Okay, so is this a good return? We are investing $1.3 million, and after 1 year we obtain profits of 139. How much is it? Well, we divide this. NOPAT divided by capital, and it's 10%. That is the return on invested capital. This is a very simple idea. If the return on invested capital is NOPAT, how much we earn, divided by capital, how much we invest. Therefore, if you have earnings, operating earnings for $30, is this good? Well, it depends. If you obtain $30 with $100 investment, well, this is a 30% return. It may be interesting according to the risk. But if in order to obtain those same $30 in profit, you need a higher investment, for example, you need more equipment, and you need $1,000 investment, then this return will fall to 3%. Not very interesting. The same as we could obtain with a, let's say, a T-bill or a bond. So NOPAT compared to the amount of capital will give us an idea of the return that this business is generating. That is why it was important to forecast the balance sheet. Most entrepreneurs forget the balance sheet, and they just forget, they just forecast the P&L, the profit and loss, and they forget to forecast how much assets they will need. There's no way to calculate a measure of return on capital without forecasting the balance sheet. This is not a formality. This is a very good idea. If this is my own money, then I want to know how much is the return I'm expecting to obtain. Okay, let's calculate the return on invested capital for each year. I will copy for every year. And for example, in this case, you can see it will increase. Why? Where, for example, for 2019, we are expecting to obtain $263,000 in profits with an investment of 1.7. Well, if you remember the way we forecasted the balance sheet, this makes sense because not all the assets for this project are fixed. Some of the assets are fixed, others are variable, meaning that we are expecting that with the growth of sales, we will need some new inventory, we will need some accounts receivable, but some assets are fixed. We have benefits of scale. Some assets, like the office building, the vehicle, can remain fixed, increasing the turnover on those assets, and they will allow an increase in sales. Therefore, in this case, that translates into a higher return. Remember that return comes from two sources: margins and turnover. Once we finish this, we can even use the DuPont formula to open the return on invested capital in the sources, in the value drivers of such return, to see where it's really coming from. Is it coming from because the company was able to reduce costs or expenses and therefore increase margins? Or the company was not able to increase margin, the company has no more ideas to reduce costs, but it's using very efficiently the assets. It's calling to collect accounts receivable, it's moving the inventory, and therefore it's obtaining a higher return, not because of margins, but because of assets turnover. Okay, so we will do this in different videos. You can see different examples of the value tree, of the DuPont formula for the return on invested capital. But now, to finish our example and to determine whether this is a good project or not, we would like to calculate the economic value added. I will remind you the formula. Economic value added is the capital times the return on invested capital minus the weighted average cost of capital. For example, if you're expecting, let's say, 15% return, and the weighted average cost of capital is 12% return, then you are creating value because the return you are obtaining on this project is higher than the opportunity cost of such capital. The weighted average cost of capital represents the profitability or return of other companies of similar risk. Therefore, in this case, 12% means that if you go with your money and you go to invest in the competition or in a company of similar risk, you will obtain 12%. But in this project, you are obtaining 15%. Therefore, you are creating value. How much value? 3% for each dollar invested. 3% for each dollar invested. So now, what can you do to increase value? Well, you could increase the return, maintaining, of course, the risk. That could be done by, again, increasing margins or increasing turnover. Or if not, let's say you have no more ideas to increase margins, you have no more ideas to increase turnover, but you can grow and still be efficient. You can grow maintaining such return. Therefore, the EVA will increase. In this case, how much will EVA be? Okay. If this is a small company, for example, $100 company, you start the company with $100 and then you end up with 103. Value creation is $3. But if you are capable of maintaining this 3% spread while growing, then a bigger company will lead to more value creation. That is EVA. Of course, this does not work if the difference is negative. Let's say you have a minus 5%. For example, in case the weighted average cost of capital is 20%, then you are destroying value in this case, and growing will only have the opposite effect, will destroy more value. You don't want to grow a company that has a negative spread between the return on invested capital and the weighted average cost of capital. Okay, let's calculate the EVA for this example. We have the three elements above. Here we have the capital on line 76. We have the return on invested capital. We know that the weighted average cost of capital is 12% for this company. So EVA will be capital times the return on invested capital minus the cost of capital. It's going to be negative for the first year because, as you can see, return is only 10%, but other companies are having a return of 12% for a similar level of risk. But it turns positive. For example, here this company is expecting to obtain a return of 15%, and the cost of capital is 12. Therefore, we have a positive EVA. Now, what is the total result? Can we just simply add the EVA of each year? No, we need to discount these numbers to present value because these are US dollars. Value creation is expressed in this case, US dollars. Do we need to calculate again the discount factor? No, we can use the same discount factor we had before. Therefore, let's repeat this EVA on line 89, and then let's find the discount factors we already calculated for the free cash flow approach. And now present value of EVA will be the EVA of each year times the discount factor. If we add all these numbers, now in present value, of course the result is the same as net present value. If the EVA is positive, the conclusion, the interpretation is the same as net present value. The EVA in this case is positive. It means this is a good investment project, at least according to our assumptions, to our forecasts. If the EVA is negative, well, it means the project will destroy value. Not a very good idea. Okay, thank you very much. I will see you in the next video.